Okay,
Hi, Cedric.
perfect.
Hi,
Hi,
Sabrin. Hi, Karim. How are you?
hello everyone.
Hello.
Hello.
Perfect. So I think we're live, right, Jonathan?
Yes, we are live and people are putting in. We have 54 is still claiming. People are still coming in. So give it maximum 59 seconds and we get started.
Okay. Well, we are already like 60, close to 70 participants. Well,
Yeah.
increasing. Perfect. Great. And so what we used to do at the beginning, so everyone in the chat, if you want to tell us from which place you are connecting, very happy to see from which city, which country you're joining us. Usually we have someone, I mean, people from all around the world.
Yeah. Yeah.
So let's hear from everyone. So you can just mention your name and where you are from.
In the chat.
Yeah. Can you see it, Jonathan? I can't see.
Here from Mitchell. Yes. It's in the chat, Cedric. India, New York, Kenya, Italy, Ghana.
What a
Switzerland.
lovely mix. Yeah.
Yeah. It's a global community right here.
Yeah. Okay, see our friends from IRRI. Great. Italy as well, Ghana, London, South Africa.
Yeah, I see Congo.
Nice. It seems I'm the only one from France, but it's okay. I won't be I'll be
Just for somebody gonna join you just now.
because it's in English, that's why maybe. Okay.
Well, I don't see anyone from the UAE. Oh, there you go. I see Saudi
Ah,
Arabia
you
now. Fantastic.
UAE is
Hello.
there.
Fabulous.
Perfect. Great. So I think we can get started. Should we? Yeah, we can start slowly. We are we are almost yeah, we should have almost everyone. Should we give it a go?
Yeah, people are putting in, so we can give it a go. Yeah.
Perfect. So thank you everyone for joining us today. We are very happy to be here. We will speak today about the Human Planet Accelerator. We have with us um, Vikram Raman, who is investment director from portfolio director, sorry, from Schneider Electric, calling from Singapore. Thank you for joining us, Vikram. It's great to have you. And yeah, thanks, Vikram. And we will give you also time to introduce yourself, and we'll have a very interesting discussion in a few minutes after the presentation. And we have also Sabrin, partner from Human Planet as well. Thank you for joining us, Sabrin. Do you want to introduce yourself quickly?
Of course. Hi, everyone. I'm Sabrin Rahman. I'm based in the United Arab Emirates. I've lived here in the Gulf region for almost 20 years. So, working across a variety of institutions such as HSBC, where I was the Managing Director of Sustainable Finance and Sustainability, as well as for various federal entities and think tanks on strategy and sustainability. So, I'm really excited to be a part of the discussion today.
Great. Thank you so much, Sabrin. Actually, I just realized I didn't introduce myself as well. So I'm Cedric, partner at Human Planet. I'm based out of Paris. And I'm very happy to be organizing this this webinar with everyone. So few words on Human Planet before we start. I think most of the audience know us already, but very briefly. So we are an impact finance advisory firm, and we connect private capital and capital markets with very high impact initiatives around the world across many sectors. And the goal is really to mobilize resources and mobilize investments in different forms for positive social and environmental impact in our societies. So that's what we do. What you see here is actually all the types of partners we work with, because we are into impact space, impact finance. So we work with NGOs, we work with social enterprises, we work with startups, with corporates, with investors, funders, donors, many types of players, and we engineer financial solutions that bring everyone into the same goal, which is to scale positive impact. So today the objective of this webinar, so it's actually a 3-day webinar. So for the ones from you who have enough courage to follow us during the 3 days, I think last time it happened. So very happy to have you. The 3-day webinar is to share some of our insights and to share value, with the audience, and to also introduce the Human Planet Accelerator. We'll share a bit more about the accelerator itself. And today is the first of the 3 sessions, which will be really focused on investment, funding, and what makes a project what we call investable. And this is why we are very happy and lucky to have Vikram today with us, who will share from his perspective within Strict, what makes a project, an initiative, interesting from the investment side. So we'll share quite lessons learned from our side, from Vikram's side as well. And the idea is really to share with the audience, what are the key success factors for before presenting to investors, and to have something which is investable. Before we start, this is a QR code to apply to the Human Planet Accelerator. We will share also later on, if you want to apply, we'll explain a bit more. Also, you have the opportunity actually to book a consultation with us directly if you want to know more about the accelerator, and also to get some advice or some feedback on your on your projects, on your case. Happy to book a consultation. Jonathan, in the backend, if you can actually also post the link in the chat so that everyone is free to book a consultation, and also the link for the accelerator, so everyone will have it. Thank you, Jonathan. And before we start, actually, before we deep dive, we have two questions actually to know who is in the room. I think we have quite many people today joining us. So I think the first question, yes, it's an interactive poll, so you should have the possibility to answer. So where are you in your fundraising journey today? Either you haven't started yet, you are exploring options, you are actively fundraising, or option D, you have already fundraised and you have fundraised quite a lot of money and you are in disbursement mode, which in this case, we are very happy for you. And question number 2, which will be after. So maybe we can start. Jonathan, do we have the answers for the first question?
Yes, the answers are pouring in. So we having started, we have 57%, not 12%, sorry. And then exploring options, we have 44%. Actively fundraising, we have 37%. And already raised capital, we have only 5%. That means that people in the room needs to raise capital.
Okay, perfect. And we have around 10% who have not started, right? Okay, so
Yeah.
this one, it's really, fundraising should be like every day, actually. We are always in fundraising mode, but very interesting to know. Second question, what is your fundraising challenge? So finding the right investors. So sometimes it's a question of network, structuring the financial ask, demonstrating measurable impact, or building a compelling pitch.
You just put that also into the comment section. Question 2.
Yeah, so you can answer in the comments if it's not appearing here, and we'll have a look of the answers. Okay, do you see anything, Jonathan, in terms of answers?
Yeah, answer coming A. We have A. Majority is A. Spotty in the chat.
Okay, so it's really to find to find where the money is actually. So we'll discuss it today. I think also what we want to discuss is actually once you have found the investors, it's only 10% of the journey which is done, because you have to pitch, to explain your project, and actually to answer the questions, which is really like when it becomes challenging. And yeah, so in terms of introduction, we have a few concept and insights we want to share with the audience before we do the interview with Vikram here. So I will give the floor to you, Sabrin, to start the presentation.
Wonderful. Thanks, Cedric, and hi, everyone. So I'll kick off our sort of foundational discussion initially, really talking about the fundraising landscape. And I wanted to put some of this into context. So maybe a number that has changed many of our jobs this year. So in April, the OECD published their preliminary figures for 2025, where official development assistance came to close to $175 billion. So that was a fall of 23% in real terms year on year. So $50 billion in one go, gone. And that was a significant figure because it was one of the largest annual contractions in the history of official development assistance. So aid as a share of donor income fell significantly, and it didn't fall evenly. So humanitarian aid fell almost 36%, bilateral grants, the money that most organizations actually live on, fell 29%. And the LDCs, or the least developed countries, lost 26%. So sub-Saharan Africa, for example, lost 26%. So 5 donors accounted for 96% of the entire decline, which is incredibly worrying. And I'm being careful here because there is a comforting story, and that is available. That obviously it could be a one-off, it could be a bad year, an election, a budget. It will bounce back. But if you look at the OECD's projection for 2026, it fell another 6%. So the reality is, in many ways, that it's not a dip, which we initially thought. It might be a reset. And so that's what really takes us to these sort of 3 circles that you're seeing, right? Most people see these circles and they think, is it a ladder? Do you climb, right? All the way up to commercial capital. So philanthropy at the bottom, and so forth. And your job as an organization to reach commercial capital is to climb. But that is probably one of the most expensive misconceptions in our sector. So it's not a ladder, it's actually a stack. And in almost every deal that I've worked on, both in private finance and in blended finance, all these 3 can really present in the same transaction at the same time if it's done right and structured rightly. Because each circle here has a very specific area that it is uniquely good at. So let me unpack that a little bit more. So philanthropy takes the risk that nobody else will take. The first loss, the guarantee, the feasibility work, and sometimes the innovation that might be missing in the market. And then you see impact capital, which is patient. It's priced, it's pricing risk against a measurable outcome. And then commercial capital comes in usually at scale and only when the risk has been made legible. So we do have a question that, am I speaking to a presentation? This is the presentation on the screen to the person who's just asked. So the way that we want to make this come to life is with examples. So for example, Inclusio in Belgium, it began in 2013 as a social housing vehicle. It was impact first, small and unproven. And then in 2020, it listed on the public market and raised about 153 million euros as a regulated real estate vehicle, with a 3.5% target yield and also a B Corp certification. And now it holds 1,000 social housing units and houses over 2,500 residents. So why am I sharing this example? Because it's the same asset, it's the same mission, but it went from philanthropy to commercial capital in 7 years. So philanthropy didn't disappear when commercial capital arrived, but it made it possible to work side by side. So I think what I'd like to leave as I move to the next slide you with is that the money hasn't left our sector or our broader area. It's just changed the terms. So it's really moving from grants that ask you to report activity to capital that asks you to evidence outcomes. And organizations that are able to make that shift will also find that there's more capital available this year and onwards, and then those who are waiting for aid budgets to bounce back. So this slide now that we're looking at is really looking at how impact capital is really no longer a niche term or a niche area. So as I mentioned earlier, aid fell 23%. So where did the money go? Did it evaporate or did it move? So these figures have been taken from the Global Impact Investment Network's market sizing. So Global Impact investing assets under management stand at about $1.57 trillion. And it's managed by about almost 4,000 organizations. Now, according to the network, they also put the compound growth rate at about 21%. Now, aid minus 23% in 1 year, impact capital plus 21% every year, year on year. So what's interesting is that these two lines crossed some time ago. So we're living on the other side of this crossing, and I think we're now starting to understand that we need to update our fundraising strategy to match. So the 4 points that we've listed here in terms of key growth factors really explain why this is a structural rather than just a seasonal change. So what we're seeing is regulation is pushing capital in this direction. Asset owners are being required to evidence where their money goes. Private capital is filling a gap that the public finance just cannot fund or has vacated. And none of these are reversing. And I also want to talk about the fact that it's not just good news that the capital is shifting. Remember, a $1.57 trillion market is not the same as having all of that cash or all of that funding available to you. And some of the things that Cedric and I and our colleagues have faced over and over again is that, it's never a constraint of capital. It's actually investable organizations. And I'm sure Cedric will talk about that as well. What we've seen in our experience is that there's more money or investors looking for credible impact deals than sometimes there are credible impact deals looking for investment. And that gap is very, very specific because I know that the audience that I'm speaking to here are looking for fundraising or investors. Most NGOs and impact organizations are very grant ready, but they're not investment ready. And those are very, very different competencies. So being grant ready means that you write an incredible and incredibly compelling narrative, you manage compliance very well, you report on activities. Investment ready means that you can evidence an outcome at a unit level with data a third party will verify on a timeline that someone can underwrite. And this doesn't come naturally, we know that. And most organizations have never had to build that because no grant or donor has ever asked them for it. But this is the journey that I think many organizations are on. So one example of what closing the gap or that transition looks like is, for example, S4S Technologies in India. So they focused on solar food dehydration delivered through female micro entrepreneurs. Now, what made them fundable was not the story, which is incredibly compelling. It was that they could evidence per entrepreneur an income increase of about $725 a month across a cohort of almost 10,000 women, alongside roughly 300,000 tons of crop waste and CO2 avoided every year. So you can just see the impact metrics are just ballooning. And once that measurement spine existed, the conversation really moved quite effortlessly between being a grant and being more of a pay for success model or contract. So again, the same organization, they're doing the same work, but it's a different instrument because the evidence is something that could be underwritten. And so if we move to the next slide, which is my last slide before I hand over to my colleagues, this is a really practical one. So if you were looking for blended capital today or tomorrow, where is it actually pooling? So we've looked at a few sources, but this has been taken from Convergence, who track global blended finance markets. So in 2024, there were about 123 blended finance transactions worth about $18 billion. And cumulatively, the market is worth about $249 billion across almost 1,400 transactions. Private capital accounted for about almost $7 billion of the 2024 raise. So the bars here are actually showing where these deals were clustering. So financial inclusion saw a very, very good amount of leads and deals at 56% and so forth. So healthcare, education. So I just want to also raise that these bars do not add up to 100 in case someone in the audience does do the math very, very quickly. They're not meant to. So many deals, have multiple sector tags. So a solar irrigation facility for smallholder farmers might be tagged as agriculture and clean energy, for example, or even financial inclusion. So that's why there is a bit of discrepancy there. But what we wanted to show you is just really the thematics that are showing up from a data perspective. I think a few things I wanted to highlight. Number one, scale. So $18 billion, it does sound enormous, particularly for us in our virtual room today. But if you then compare that to the $4 trillion deficit in achieving the Sustainable Development Goals, that becomes under 1%, right? That $18 billion only accounts for 1%. So blended finance is really not something that will replace aid. We're not saying that, but it's what will make very specific, well-structured propositions financeable. So I don't believe any facility can rescue underfunded program, but it is one of these wonderful opportunities to really scale and multiply the aid and the capital that's available to you. Um, the second I also wanted to raise was around ticket size. So the median blended finance deal, for example, in 2024, was about $65 million. And I mean, I can say, quite confidently that that transaction size is massive, right? So that doesn't really, it doesn't really sort of point to any one organization, but it helps us understand that many times organizations like yours actually get in through facilities and platforms that then aggregate many small deliverers under one single structure. So there's also ways of collaborating and clustering under a certain theme. So I'm going to stop there. We've got lots of examples, but what I'd love for you to do is find your sector in this cohort, think about instruments that dominate and ask yourself questions, right? So what evidence do I have? What am I able to prove for somebody writing that check? And that's what Cedric and Vikram will hopefully unpack for you a little bit more. So I'll stop there.
Thank you very much, Sabrin. Thank you so much about all this insight. I'm sure it's very, very useful for the audience. So I will continue before having the discussion with Vikram. What we wanted to do is actually to share kind of the toolbox and a few notions that will be useful for you, and so that you also understand kind of technically some concepts. So when we speak about impact investment and innovative finance, there are several tools actually that can be mobilized. And even if you're an NGO, a startup, or even an entrepreneur, you can tap into these different instruments, but it's really depends on where you are today, the stage, the maturity of your initiative, and the scale. So I think the first one is actually the traditional grants, which are really the entry point, which actually we also advise on within the Human Planet /MZN ecosystem, and actually it's one of the bases, right? But as we mentioned, the issue is around sustainability and that it's not something that you can sustain in the long term, and you need to fundraise again and again. So that's why there are some interesting other tools that could be leveraged. Actually, we'll start at the bottom, which is the bonds, equity, and debt that you see the last two, which are actually more for corporates and private organizations, and these other two, which are impact bonds and blended finance. These are actually where we have actually, as Human Planet, I think the majority of the financing that we structure is within impact bonds and blended finance, because it allows you to be in between. So between grants and kind of commercial capital, where you actually have high impact and you mobilize investors, which are called impact investors, who want to deliver impact. So you can actually push for initiatives which are not usually very commercial. And this is where it's important to have something which we call investable, that you can bring to investors and that investors will be confident to do. So actually what investors are looking for, this is what we'll discuss with Vikram. So I'm conscious of the time as well. I think we will move directly to the discussion with Vikram. Instead of having a slide on investors, it's actually better to speak directly to the investors, and we are very lucky to have you, Vikram, today. So maybe to start with, Vikram, if you want to introduce yourself and a bit your journey within the investment and the impact investment space, and after we can continue.
Sure. Thanks a lot, Cedric and Sabrin, and pleasure to meet everyone through this forum. So yes, I mean, it's been an interesting journey for me in the impact investing space, 20 years now since I started. I started right after completing my MBA. This was in India in May 2006 when I joined Acumen. And when I joined, Acumen, this was like at the very beginning of impact investing globally. There were just, I think, a few impact funds, and now it's very gratifying to see the space that has grown significantly since then. I have a finance background. I'm chartered accountant and did my MBA in finance as well. I mean, I've been with Schneider Electric for the last 6 years now, based in Singapore. We are deploying in Asia, emerging markets in Asia, South and Southeast Asia, focused clean energy access and transition fund. It's a pilot fund. So Schneider Electric, just to give you a bit of context, has been pioneering corporate impact investing since 2009. So it's nothing new for us. So we've anchored multiple impact funds. And I'm very closely involved with an Asia-focused fund that I was just talking about, which is 6 years now since its launch. We fully invested from first fund. I'm now actively fundraising for the next fund. So a bit of wearing your hat right now when a lot of you are actually actively fundraising yourselves. That's the same case even for investors like us. So we need to keep raising funds to be able to deploy subsequently. So yeah, that's just a quick intro about myself.
Great, thank you so much. And no, it's very interesting. I did not know actually you started with Acumen in the beginning, so you actually, yeah, it's really impact investment, and I think it was not impact first investment in the beginning, but it's always has been like very strong on impact, right?
Yeah.
Specifically.
That's true. It was when I joined Acumen, it was called social venture finance or something like that. The term impact investing was coined only in 2007, if I remember right.
Yes, exactly. Yeah, perfect. So I think I have a series of questions, but let's make it also a kind of interactive. I think as we saw initially, the first question or concern, it was for the audience. It's like difficult to meet investors, right? But I think it's even more difficult when you are actually facing an investor, right? So my first question is like, for you as investor, when you screen and you meet an entrepreneur, someone who is actually raising funds, what are the key, the top 3 things that you actually look at and that will give you within a few minutes kind of good to continue or some red flags about the case?
Yeah, narrowing down to the top 3 is very difficult, but
Or
I mean, to
maybe,
start with, yeah, I
yeah,
mean, no, I think it's a very important question. But to start with, I think what we and investors in general look at is at a very preliminary level, is there an alignment with our scope of the fund? So every fund has its scope, its mandate. So that's the first check that you look at. I mean, is there a geography alignment, sector alignment, stage alignment, and size also? So these are very important checks that we do. Impact also, is it aligning with what we want to do as an impact first or impact aligned fund? So once it clears these, then you look at, you go a little bit deeper into what has been shared. What is the solution? What exactly is this business trying to address? How unique is the solution? What is the market? Is it large or small? And then you look at the team. Who are the founders? What is their track record? Is this their first business or venture? Have they tried and tested some startups in the past? Do they have like a rich corporate experience? What are the complementary skill sets? So these are things that you look at. And if I may also add, trying to map, coming from the initial stages of the business to where it's come now, the status, its performance, and going forward, what is, how do the projections look to the, does the model look realistic enough? So these are, I think, some of the key elements that you look at within, when you have like a pitch deck in front of you for the first time, even before you get onto the, first call with the founders.
okay. Very interesting. And so maybe to continue on this one, so because when you look at a proposal, right, you have it's either the funder, so what I understand is like you assess, so first the strategic alignment, is it aligned with your strategic of investment?
Yep.
And after you have criteria which are either focused on the funder or on the startup itself, right? So, and for you, is it like there is a balance between the economics of the project or the startup and the team and the capabilities of the team to implement? And do you prioritize one, or it's like you need a good team with a good idea, necessarily?
I mean, the fundamental thing is you're backing the entrepreneur or the team that is executing, right? I mean, you can have an excellent business model. It's going to sound great on paper, but it's on paper. So who is the one who's actually implementing it on the ground? What is the vision of the founders? I mentioned about complementary skill sets. So, is there actually some sort of complementary skill sets among not just the founders, but also a broader management team? So it can't just be one or two founders that is driving it, but you need someone like a middle management layer to lean on. So all of this needs to be taken into consideration. So I think that is the single most important factor. If you ask me, ask any investor, they would say they bet on the entrepreneur, whether this model will succeed or not. And I think in many cases where things go wrong, it's either in terms of lack of execution capabilities or the lack of alignment between the investor and the entrepreneur also. So that I think needs to be very clear right from the beginning.
Mm-hmm. Okay.
Can
No,
I
very
add something? Sorry, Vikram, if you don't mind. I
Sure.
think what you said is spot on because it comes down to risk management, right? And the more you can, it's not just de-risking capital, but the business model, the rational reason why an investor would support this, right? What problem is it solving? Are there any other entities who are solving that? So there's such a broad set of risk metrics as well that I think it's good for entrepreneurs and impact organizations to understand from the other side.
Absolutely. Really spot on. Thanks for that.
And no, very interesting. And maybe my follow-up question actually is more because what is unique and what we are discussing today also with the audience, it's around impact, right? Impact investments, you have the two notions, and specifically for, also for, the people coming from the NGO background are very focused on delivering positive impact. Sometimes we think that there is either a trade-off between delivering the impact and having something which is bankable or that can be pitched to investors. So the question would be, and also you see it, I think, in the startups that you do screen. So what is the balance and for you a good value proposition, and what is the right balance between the positive impact and the positive economics of a proposition?
I think this is a question that is asked of every impact investment fund. And I honestly think, having worked with multiple funds and now at Schneider, they should not be a trade-off. I think both are important. Impact investing per se, going by the very definition, is you have, the intentionality of impact, which is social and environmental, but that comes along with your drive to achieve like a exit over a period of time with a decent financial return. So it has to go hand in hand. Without the impact, it would be like any other typical VC, and just purely focusing on impact. We might just have like a grant-minded approach. But so that's the beauty of impact investing, where you try to have a blend of both. So what would be like a compelling case? I think it has to be one, you need to have a viable market solution. It needs to be scalable. And there need to be clear exit possibilities. So when an impact investor is putting in money now, there would be an expectation to exit. You mentioned about patient capital, Sabrin. So there would be an expectation to exit in like 5 to 7 years' time. And some can get stretched depending on the business model. But there is always that expectation. So you need to have your capital back plus a certain return. This certain return is not going to be, typically it's lesser than what a tech VC would expect, or like a angel who's looking for a quick exit within like 2 to 3 years would expect. But there is an expectation that has to be a decent IRR, which is also subject to how the fund has been created. And at the same time, you need to deliver on the impact objectives that you've signed up on. So depending on the model, if it's solar rooftop, so many tons of CO2 savings, so many jobs created if you're working through channel partners. So these could just be high-level examples, but it changes and needs to be agreed based on the specific investment on a case-to-case basis. And on the other hand, if it is something that is not seeing all of these factors blending in, and to an extent, some models can't be for profit. They need to be backed by grants or by soft loans. Like, for example, just taking global examples, vaccine delivery, or if you're looking to reach the hardest to reach sort of population, who are the really low income strata, some of the solutions that are being proposed are highly impactful, but they're not necessarily something that can be backed by impact investing or particularly equity. You can still have some soft debt that goes in. So it depends on the model, and you need to understand where it fits in, depending on the nature of impact that you need to be delivered, also in terms of the possibility, the scalability of the model, and to what extent it can deliver a financial return.
Very
I hope
interesting.
that answers your question.
Yeah, definitely. And if we continue on this idea to deep dive a bit more, because I think it's the case for quite a few of the in the audience today. So, and maybe we can take the example of what you have seen in the energy market in Asia, because for an organization which is relying on grant mainly, and pivoting to, from grants to impact investment or to an investment, it's not, it's very difficult and it's not something which is easy. And I think, unless I'm wrong, I'm not the specialist, but in the energy access, it was the case because the market was not very mature initially, right? So a lot of players initially were also, and some of the players were also relying on grants, and they had to scale to pivot, from grants to actually impact investment or investment ready solutions. So maybe if you could share a bit more on what happened. I mean, am I right first? If I'm wrong, you just let me know. But if it's the case, what have you seen in terms of this transition from grant to impact investment in the sector, and what, how it could be modeled for other sectors?
Sure. I can just deconstruct that. So from our existing portfolio, from current fund in Asia, we have 13 investments, 6 in India and 7 in Southeast Asia. All of these from the outset were in for-profit sort of entities, so they did not have to transform from a non-profit, from an NGO into a for-profit vehicle, just for us to be able to invest. But from our European fund, which is the first evergreen fund that we set up in 2009, there's a bunch of investments that we back that are actually in NGOs. So this was structured primarily because our European vehicle is funded by employee contributions, and there's also, I think, French regulatory norms that allow us to invest, or it doesn't have to be pure equity investments, but with a nature of lesser returns, but primarily focusing on impact. So I think that was possible. It was a unique case from the French fund that we have. But in the Asia context that we are basically engaging with, and maybe to broaden the response a little in terms of how an NGO can transform into a for-profit entity, my first reaction is it doesn't have to. So be careful at this transformation moment. There are some models, as I was saying earlier, that are primarily, I think, grant-based. If you just suddenly transform that into a for-profit entity, you're going to lose your footing. Even the existing grant money that's coming in will probably sort of taper out. So be very careful on that. But if you're willing to transform after many years into a for-profit model, then it requires a mindset change. It requires thinking, delinking yourself, reducing reliance on grants, and how you can position the business to attract equity, or slightly moving from zero-cost debt or something that is repayable over a period of time. So there are mezzanine instruments that are available in this context. So that could be one avenue. The other option is, you could continue as a nonprofit. So you could split your business into two components: one that continues with a nonprofit sort of ethos, and to look at a market opportunity within your own existing business that can be hived off into a separate enterprise, that can be a for-profit enterprise, that can attract impact investing. The NGO can continue to be like a majority holder in that controlling owner, so to speak, of the for-profit entity, so you don't lose control or oversight of that. So that could be one way. We're also seeing some hybrid models. Like one company in our existing portfolio, Urja Development Solutions. So they are in solar irrigation, and they work with smallholder farmers. So the unique thing about this company is that they don't sell the pumps, solar pumps, to the farmers. They own the pumps. So the asset is completely on their balance sheet, and they let the farmers use it on a pay-per-volume basis, pay-per-use basis. And this way, farmers who can't afford to buy these pumps outright can use them as and when required, and pay very little, so the capex financing is taken off their heads. They also switch from diesel pumps. The cost of diesel has been increasing significantly with the Middle East crisis. To add to that, so that is one example that can be demonstrated in terms of a hybrid model working out, where it's a mix of equity-based funding to scale the pumps, but also Urja continues to receive grants that help the farmers with advisory, with soil inputs. So it's sort of a blended approach there.
Great. No, very, very interesting, actually. So I learned quite a lot. And I'm conscious of time as well. Maybe one more question around blended finance, because it's something on our side, we work a lot. I know it's a concept which is a bit difficult and for everyone. So maybe on your side, what was your? It's also a topic we have discussed together. What's your I mean, it might be a difficult question actually because it's something complicated to answer in a few seconds. But what's your approach to blended finance and how you leverage it in your in your maybe not your current investment, but in the upcoming activities within your team?
Yeah, no, I think that's a good point that you raised. So blended finance is not something that we have actively tapped into in the past, but now we're doing it for our upcoming fund, which Cedric was mentioning about. So this is being structured as a blended finance vehicle where there's a first loss component and there's a senior layer. So basically, blended finance is where you have a concessional capital coming in that helps attract larger commercial investors. So the first loss capital takes a risk. If there is something that goes wrong with our portfolio, the first loss pool gets paid at the end. So the senior or the more commercial capital gets priority in repayment. So that way, it de-risks a capital raise. So that's a very important aspect. And the other benefit that blended finance offers in this context is it helps us back very impactful businesses and take the risk of backing them at an early stage. So if you just raise commercial capital that is expecting 20% plus IRR from the word go, we will not be in a position to back many of the impactful enterprises like Urja, for example, that require some sort of a hybrid model for them to scale, so which is also very important from a portfolio diversity point of view. So blended finance, I think then it becomes extremely important to maintain that diversity in the portfolio and also help additionality factor to raise commercial capital.
Great. Thank you so much, Vikram, for all the insights. I was checking through the chat. We have quite a few questions and a few people saying it's a very interesting insight, and I do agree. Thank you so much, Vikram, for having joined us today. If you can stay with us for the Q&A, I will just thanks, Vikram. Before we move to the Q&A, share quickly on the Human Planet Accelerator. So the accelerator is actually a program that we have launched for more than 1 year already. We had 3 to 4 cohorts, and the goal is actually to select and to support some organizations. So it can be NGOs, it can be startups, it can be even bigger organizations. The idea is to have a problematic, a thematic, and to be looking for tapping into innovative finance and diversifying access to funding. The program is actually a 5 month program where we start with the diagnostic. So we check, what can be what can be done in terms of financing. So we need to understand if there is anything which can be monetized, what are the operations, who is the team, etc. And based on the diagnostic, we move to the design of the financing solutions. We structure it, and actually after that, it's really like full speed on fundraising mode and engagement with our network of investors, donors, quite a diverse network globally. So this is what we do. The call. So we have a call for proposals. Jonathan, if you can add the link in the chat for everyone to see the accelerator,
Sure.
would be great. And also there is this QR code on the screen. Jonathan, if you can also add the Calendly link for anyone who wants to book a consultation. The idea of the consultation is either if you want to know about the accelerator, and we can share some insights, but even if you want to, following this webinar, if you have any question or if you want to actually discuss your project, happy to discuss it with you and share some insights. It's no cost at all. It's really someone from the team will be with you for 30 minutes and discuss and give you even directions and feedback about your project and your goals. So yeah, I think we have a few minutes left. We might be extend by 5 minutes so that we give the time for the Q&A. Jonathan, do we have any questions already? I think I saw a few questions in the chat already, so maybe I can.
Yes, we have a few questions in the chat, Cedric. Can you just go over them, please?
Yeah, maybe
Cedric, I'm happy to take one of the questions that I saw pop up from Janet. I think she's talking about care reform and their work in the care economy. Janet, in a nutshell, if you are able to prove that your approach, your program, or your intervention is cost effective vis-a-vis other solutions in the market, there is a very, very strong case, right? So it's not about your impact thesis generating X amount of revenue as such. It's also avoided cost and efficiency that can be priced. So for example, one of the examples I can share is B Code in Brussels, who kind of showed that training one job seeker cost about 4,500 euros. Whereas if that person is unemployed, it costs the government almost 40,000 euros, right? So once you can quantify that, you can attract other forms of capital, whether it's sovereigns or government, who realize that actually intervention is cheaper than solving a problem. So that's where we kind of really specialize in turning your track record into an investable story in terms of avoided cost, but also opportunity.
Great. Thank you, Sabrin. So after I'm trying to see the other questions, and yeah, on the care, actually, I think we have a few case studies on our website actually, also that can be looked at. I thought there was a question. So yeah, I'm not asking it to Vikram because it's confidential information. It's about the returns, but I can take it. So actually, the question to share it with everyone is how much percentage return is usually expected from investments, and how the returns are to be delivered, and what is the investment period, etc., etc. So maybe Vikram, you want to say a few things or?
Just in terms of comparison with commercial investors, so any commercial investor you speak to would expect at least 20% IRR, and that's at the bottom end. So it goes, it
On
depends on the
equity, right?
sorry?
On equity, right? Like
on equity, correct. So just to clarify on equity. So when it comes to impact funds, typically, I can confidently say it's lesser than that. But again, it's not the case for every investment. So there are some investments that are slightly more commercial in nature in terms of the scale potential, where impact investors also can expect, depending on the model, a higher return. And if it's just purely impact driven, and then you expect a return of capital plus a certain markup, then accordingly you revise your expectations.
Exactly. And also, yes, so this is for equity, and and I think for also for some of the NGOs in the space, so you can also go for debt. So in case of debt, it's much it's lower returns. It depends on the country, the currency, etc. But it's also one way to to see it. And Vikram was referring to equity, investment. Perfect. After, there are some questions on blended finance. So examples of blended finance structures. I'm trying to. So again, on our website, we have like many case studies. I think some typical blended finance structures. Actually, we have one that we are actually working on in the cohort actually these days. And I won't shout the name, but if they are here, they will recognize themselves. It's around SME financing. So a lot of so there are quite a few organizations working with SMEs, right, with small enterprise or in microfinance. And one case of blended finance is actually to have loans to finance SMEs or microfinance institutions and to group them together, right? But actually to tap into other sectors, beneficiaries who are kind of risky, right? Or to do like what we call the last mile. Like really when you want to finance, even to finance individuals who don't have like track record, etc. So in this case, we usually recommend a blended finance structure where you provide the loan to these SMEs, but you blend it with some grants, and you use the grants either to make it affordable so that they pay back, but it's they pay back with a discount, and also you use the grant for technical assistance, to build, for trainings around financial literacy and these things. So this is one example, and there are many examples. It's the same in the we have another project these days around agriculture and smallholder farmers and climate transition. So today, this is across countries. Farmers are facing climate change, and they need to transition, and they need to be more resilient. So blended finance is a way to provide financing for smallholder farmers, where you provide this financing, but they cannot afford it. So you need to find a way to reduce the rate of financing and to be more flexible. And this is when you bring donor funding, so that it's a mix of donation and a mix of commercial investment. So I think these are two examples that are we see quite a lot in the market these days. And I think we're almost at time. I don't know, Jonathan, have you other questions received by email in the chat?
Cedric, there are a couple of questions here, but I think we are already running out of time. We can push that to tomorrow's session. So the question that we did pick up to, we can pick up them for tomorrow. How does that sound?
Actually, it's a good case so that everyone can reconnect tomorrow. So we'll start the session with the answers we didn't pick up today.
Yeah, there's so many questions here. We can pick everything today.
Yeah.
And also, I'd recommend everyone please look at our website. We've done an incredible amount of work to make resources available, and then reach out to us if you need help in deciphering what that case study means. That's what we're there for. Great.
Perfect. Thank you. So application for the Human Planet Accelerator are open. Feel free to reach out. You have the link also if you want to connect. And thank you so much, Vikram, for having joined us and shared your insights. It's I think in the chat we saw a lot of thanks to you. So yeah, thank you so much.
Okay, Cedric, and thank you to everyone. Thanks for this opportunity.
And
All the best.
thanks and thank you, Sabrin, for having joined me today for the session. It was a real pleasure having you.
It's always fun. Thank you all.
Cedric, what should we expect tomorrow?
Tomorrow, what's the plan? So tomorrow we will have someone from our previous cohort who will join us. It's a startup operating in Kenya, which is called CircleEgg. And actually, anyone who is running a social enterprise or interested in the grant and versus impact investment should join, because they actually started in grants and now they are into they have secured some investors already in impact investment, so they have transitioned. And so the team will join us tomorrow, and they will also share like their journey through the accelerator and what's happening with them. Yeah. So it will be on this, and again on impact investment. So yeah.
Awesome. Thank you so much. Thank you, Sabrin. Thank you, Vikram. Thank you, Cedric. And to our community, thank you for sticking around. We look forward to having you join us tomorrow so we can keep the conversation going through. Thank you so much, and do have yourself a pleasant time. Bye, everyone.
Bye, everyone. Take care.
Thanks,
See you
everyone.
all.